Always good to have you, Gerard. Just tell me, first, what stood out to you this morning from these earnings reports, perhaps? What do you think is most reflective of the overall sense that you get for the industry?
David, thank you for having me on the call. And I would say the one thing that really jumps out is expense growth. You saw that in both Wells Fargo and JP Morgan's numbers. Now, Citi's numbers were, of course, much higher on expense growth because of one-time items. But even when you pull them out, expense growth was still quite high. And the other part was the guidance that JP Morgan gave for 2022 on the expense outlook was much higher than expected. Now, Wells, as you might recall, is in a mode of reducing expenses, so their outlook for expenses was quite good, which shows you the divergence in the stock prices today.
Yeah. All right. So let's talk a bit about that JP Morgan expense guidance. I mean, what do you make of it? What does it say in terms of the expectations you may have for the course of how this year is going to go? Inflation, obviously, an important component of it. One would think they benefit on the net interest margin side potentially from that same environment.
You're absolutely right. The benefit that JP Morgan and all the banks are going to see. In fact, Morgan identified in their guidance that revenues, net interest revenues, that is, dealing with the spreads from loans versus and other assets, less funding costs, that could be up close to 10% because of the rate increases. But to your question, it's a clear indication that the labor issue affecting is affecting the banking industry. That showed up very clearly in this guidance. The other part of it is that banking requires enormous amounts of technology investing, and that's the other area that this company continues to invest in. So a combination of labor costs and technology costs is driving expenses for the industry and not just for JP Morgan.
Gerald, what's priced into this group in terms of the number of rate hikes at this point? I mean, obviously, they're beneficiaries to varying degrees based on, their business mix. But it seems as if people have gotten pretty aggressive pricing in 3, maybe 4 this year. Have we seen the upside for that yet or not?
I think certainly there has been some pricing in of the Fed funds rate increases and is moving up as we speak. As you know, even the futures market has changed very rapidly in the last 6 weeks. So I would expect that the bank stocks have priced in at least 2 to 3 Fed fund rate increases. But the real question will be, what about when we get to this time next year? Will people be talking about another 3, 4, or 5 fund, or 4 or 5 Fed fund rate increases? And that's not priced in, obviously. And so the upward trajectory in short-term interest rates, nobody knows for sure when it will end. And we think this is going to be very beneficial to the bank stocks, and upward revisions to estimates will reflect this throughout the year.
So, Gerard, I guess I have 2 questions for you. The first is, given this conversation we're having, the fact that you do have so many of these names under pressure today, where do you see the greatest buying opportunity on this dip? And also, how does this set us up for the rest of the banks that are going to be reporting next week?
I think what we're going to see for next week is that similar issues affecting those banks on the expense side. I think you're also going to see some benefits in revenues next week. As we saw from the JP Morgan numbers, loan growth is picking up, and they talked about the pickup in commercial lending, which was a real positive, and we've seen that in the H8 data as well. In terms of buying the dip, you're absolutely right. Citigroup, though the stock is down today, they have made some enormous announcements this week about divesting different businesses in Asia and Mexico. And I think what you're going to find is that as they re-strategize this company and they shrink the profitability, and with the valuation gap being so wide between them and their peers, that could be the real opportunity here. We also know that the asset sensitivity of Wells Fargo is the strongest of all, and they certainly will benefit from the rise in rates.